Something has shifted in the financial markets. Not overnight, not in a single headline, but in the quiet accumulation of pressures that only become visible to those who watch carefully. If you hold silver, or if you've been waiting on the sidelines, wondering whether now is the time to pay attention, this video is for you. What I'm about to share isn't about hype. It's not about getting rich quickly or chasing the next hot trade. It's about understanding a moment that may only come around once in a decade. My name is on the other side of this camera because I've spent years studying monetary cycles, precious metals markets, and the psychology of investors who succeed when others panic. I'm here to walk you through what's happening right now with silver, why March could mark an inflection point, and more importantly, how to think about this situation regardless of whether you own the asset or not. Let me be direct with you. Silver is behaving differently than it has in years. The technical patterns are tightening, the fundamental backdrop is shifting, and the institutional interest that was absent for so long is beginning to return. But before we talk about charts or price levels, we need to talk about why any of this matters. This isn't just about one metal. It's about what that metal represents in a financial system under extraordinary strain. It's about inflation that refuses to disappear. It's about central banks that painted themselves into a corner. It's about debt levels that cannot be serviced at normalized interest rates. And it's about investors worldwide beginning to ask a question they haven't asked seriously in years. What happens when confidence in paper assets starts to crack? Let's start with what we know. Silver closed recently above key resistance levels it hasn't held for extended periods since 2021. That's not speculation, that's observable data. Meanwhile, global silver mine supply has been declining while industrial demand continues to rise, particularly from solar panel manufacturing and electric vehicle production. At the same time, we're seeing something unusual in the derivatives markets. The ratio between paper silver contracts and physical silver available for delivery has stretched to levels that historically precede significant volatility. When more claims exist on a physical asset than the asset itself can satisfy, markets have a way of correcting that imbalance. But here's what most people miss. They look at silver and see a commodity, they see a trading vehicle, they see something that went up in 2011 and then disappointed them for a decade. What they don't see is a monetary metal with a 5,000-year history that's currently priced as if industrial demand and investor demand operate in separate universes. The truth is more nuanced. Silver sits at the intersection of monetary history and modern technology. It's both a store of value and a critical industrial input. That dual nature has kept it suppressed relative to gold for years. But when that dual nature activates simultaneously, when both monetary demand and industrial demand surge at the same time, silver doesn't move incrementally. It moves violently. We saw this in 1979 and 1980. We saw it again in 2011. And every time, the move surprised almost everyone because people had dismissed silver as a relic, as too volatile as yesterday's story. Then suddenly it wasn't. To understand why March could matter, you need to understand what's happening in the broader financial system right now. This isn't complicated, but it requires thinking past the headlines. Global debt has exceeded $350 trillion. Not million, not billion, trillion. That debt was accumulated during decades of falling interest rates, a period when borrowing felt nearly free. But interest rates aren't at zero anymore. They rose faster in 2022 and 2023 than at any point in modern history. And while they've stabilized recently, they remain far above where they were for most of the 2010s. Here's the problem. That debt needs to be serviced, and servicing it at current interest rates is becoming mathematically impossible without either significant economic growth, which isn't materializing, or a significant monetary expansion, which means more currency creation, which means inflation. Central banks globally are trapped. If they keep rates high to fight inflation, they risk collapsing over leveraged governments and corporations. If they cut rates and expand their balance sheets again, they risk reigniting the inflation they spent years trying to contain. There is no clean exit from this position. Smart investors aren't waiting for the central banks to announce what they're going to do. They're watching what central banks are already doing. And what they're doing is quietly preparing for another round of monetary expansion. They're talking about balance sheet adjustments. They're discussing quantitative easing under different names. They're coordinating in ways that suggest everyone knows the next move, even if no one wants to say it publicly. When currency expands, hard assets respond. Not immediately, not neatly, but eventually, inevitably. Gold has already begun this move. Silver typically follows, but with greater volatility and often with a lag that frustrates investors who don't understand the pattern. The inflation narrative is also shifting in ways most people aren't tracking. Official inflation numbers have cooled from their peaks, yes, but those numbers measure year-over-year changes. They don't reverse what already happened. Prices that doubled aren't coming back down. And structural inflation, the kind embedded in wages, housing, and supply chain reorganization, doesn't disappear just because central banks raised rates for 2 years. Meanwhile, geopolitical instability continues to build. Energy markets remain volatile. Trade relationships are fragmenting. Countries are diversifying away from dollar dependence more aggressively than at any point since the 1970s. All of this creates an environment where tangible, scarce assets become more attractive relative to promises printed on paper. Let's talk about why most investors miss major moves in silver. It's not because they're unintelligent, it's because they're looking at the wrong time frame and asking the wrong questions. When silver traded at $18 an ounce, people said it was overvalued because industrial demand was soft. When it rallied to $25, they said it had moved too far too fast and was due for a correction. When it pulled back to $22, they said it confirmed their skepticism. This is how most people think about markets, reactively, short-term, emotionally. Disciplined investors think differently. They ask, what are the conditions that historically produce sustained moves in this asset? They study cycles, not headlines. They understand that major moves in precious metals don't happen because of one data point or one news story. They happen when multiple long-term forces align and reach a critical mass. Silver specifically is misunderstood because of its volatility. People see 5% daily swings and assume it's too risky, too speculative, too unpredictable. But volatility isn't risk if you understand what you own and why you own it. Volatility is the price of admission for an asset that can move 50% or 100% when conditions turn favorable. The other major misunderstanding is timing. Investors want to know exactly when the move will start, exactly how high it will go, exactly when to sell. That's not how uncertain systems work. Markets don't send engraved invitations. They accumulate pressure quietly, then release it suddenly. Your job isn't to predict the exact moment. Your job is to recognize when conditions are ripe and position accordingly with appropriate risk management. Here's a question worth considering. If you knew with certainty that silver would be significantly higher a year from now, but you also knew it might drop 10% next week before that move began, would you buy today? Most people would say no. They'd wait for clarity. They'd want confirmation. And by the time they got it, the move would already be halfway complete. This is why preparation beats prediction. The investors who do well in precious metals aren't the ones who time every swing perfectly. They're the ones who build positions when the risk-reward is favorable, manage their exposure intelligently, and have the patience to let the macroeconomic forces play out. Let's look at what history actually teaches us about silver in conditions similar to today. Not to predict the future, but to understand patterns of behavior. In the late 1970s, silver moved from under $2 an ounce to over $50 in less than 2 years. That wasn't random. It happened against a backdrop of double-digit inflation, loss of confidence in fiat currencies, and a surge in both investment and industrial demand. The move was violent, punctuated by sharp corrections, and it caught nearly everyone off guard. In 2011, silver rallied from $17 to nearly $50 in roughly 8 months. Again, this wasn't random. It occurred during quantitative easing programs, sovereign debt concerns in Europe, and unprecedented monetary expansion following the 2008 financial crisis. Once again, the move was far larger and faster than most analysts thought possible. What both periods had in common was this. Before the major move began, silver had spent years going nowhere. It had been dismissed. It had frustrated investors who bought too early. It had generated countless articles about why it was dead money. And then, when conditions shifted, it moved so quickly that most people didn't participate in the bulk of the gains. Both moves also ended in spectacular fashion, giving back a significant portion of the gains and generating another wave of pessimism. This is important to understand. Major moves in volatile assets don't end with gentle declines. They end with crashes that make people swear they'll never touch the asset again. That's part of the cycle. We're now more than a decade past the 2011 peak. Silver has spent those years consolidating, building a base, frustrating believers, and being largely ignored by mainstream investors. This is exactly the kind of setup that precedes the next major move. Not because patterns repeat exactly, but because the psychology and market structure that drive these cycles are remarkably consistent. The technical patterns forming right now bear watching. Multiple time frames are showing compression, narrowing ranges that often precede expansion. Momentum indicators are turning positive on longer-term charts. And the relationship between silver and gold, measured by the gold-silver ratio, suggests silver is historically undervalued relative to its monetary metal counterpart. Does any of this guarantee a move in March? Of course not. Markets don't operate on guarantees. But it does suggest that the probability of a significant move has increased substantially. And in investing, probabilities are all you ever get to work with. Let me tell you how serious investors are approaching this moment. They're not rushing in with everything they have. They're not selling everything else to go all in on one thesis. They're thinking in terms of allocation, risk management, and time horizon. They're asking, what percentage of my portfolio should be in hard assets given current monetary conditions? They're asking, if I'm wrong about timing, can I afford to hold this position for another year or two? They're asking, what would change my thesis? And how would I know if I'm wrong? This is mature thinking. It's not exciting. It doesn't make for dramatic social media posts, But it's what separates investors who survive long enough to profit from moves like this from those who blow up their accounts chasing every shiny object. For investors who already hold silver, this moment calls for patience and perspective. You've likely been frustrated. You've probably seen your position go nowhere while other assets rallied. You've possibly questioned your thesis more than once. That's normal. But if you bought for the right reasons, as a hedge against monetary instability, as a long-term store of value, as a strategic allocation within a diversified portfolio, then nothing has changed except that your thesis may finally be coming to fruition. The temptation now is to sell too early. When an asset that's been dead money suddenly starts moving, your first instinct might be to take profits, to get your money back, to reduce exposure before it disappoints you again. Understand that instinct, acknowledge it, but don't necessarily act on it. Major moves in precious metals tend to go further than seems reasonable, and those who sell too early often watch in frustration as the best gains happen without them. For investors who don't yet hold silver, the question is more complex. Is this the right time to start building a position? The honest answer is that no one can tell you with certainty. But here's a framework for thinking about it. If you have no exposure to precious metals and you're concerned about the macroeconomic factors we've discussed, monetary expansion, debt levels, inflation, currency instability, then some allocation makes sense regardless of short-term price action. Not all your capital, not money you need next month, but a meaningful percentage of your long-term holdings. The way to build that position is methodically, not emotionally, not all at once trying to catch the exact bottom, not waiting for absolute confirmation that the move has started, because by then you'll be chasing, but gradually, with a plan, understanding that you're buying probability and positioning, not certainty. If you currently hold silver, either in physical form or through financially sound vehicles, let's talk about what this setup means for you specifically. First, recognize that you're in a position of patience. You're not chasing, you're not trying to get in, you're already positioned. That's a psychological advantage that's easy to underestimate. When markets move fast, the people who do best are often those who are already in place, not those scrambling to catch up. Your focus now should be on managing the position intelligently, not on predicting every short-term move. That means having a clear understanding of why you hold the asset. If you bought silver as a monetary hedge, as portfolio insurance, as a long-term store of value, then short-term price swings shouldn't change your thinking. Your thesis either remains intact or it doesn't. It also means resisting the temptation to trade around a core position unless you have genuine skill at short-term trading. Most investors don't. They sell into strength thinking they'll buy back cheaper than watch the asset run away from them. They trade out of boredom or anxiety, not because their thesis changed. This is how people turn potential winners into mediocre returns. Consider instead whether this might be a time to do nothing. Not because you're paralyzed by fear or greed, but because your position is already sized appropriately for your risk tolerance and time horizon. Doing nothing is an active decision when it's based on discipline rather than indecision. If the move we're discussing materializes, your challenge will be different. It will be managing euphoria, not disappointment. It will be deciding when to take partial profits, when to let positions run, when to rebalance back to your target allocation. These are good problems to have, but they're still problems that require clear thinking. The investors who do best in major moves aren't usually the ones who hold from beginning to end. They're the ones who have a plan for scaling out gradually as their targets are met, who take some risk off the table as prices rise, who balance the desire to maximize gains with the reality that markets don't move in straight lines. If you don't currently hold silver, but you're watching the situation with interest, let's be clear about what you're facing. You're in a different position psychologically. You don't have the comfort of already being positioned, but you also don't have the anxiety of watching a holding swing wildly. Your challenge is deciding whether to act, and if so, how and when. The case for building some exposure now is straightforward. The macroeconomic conditions favor hard assets. The technical setup suggests accumulation by informed money. The risk reward from current levels is potentially favorable if you're thinking in years, not weeks. And having zero exposure to precious metals when monetary conditions are this unusual is itself a form of risk. The case for caution is equally clear. Markets can stay irrational longer than you can stay solvent. Silver specifically can experience sharp corrections that shake out weak hands right before major moves. And jumping into any asset just because it's getting attention is usually a recipe for poor timing. So what's a thoughtful approach? Consider starting with education and a plan. Before you invest a single dollar, understand what you're buying and why. Understand the difference between physical silver and paper proxies. Understand how much of your portfolio should reasonably be in volatile assets. Understand your own emotional tolerance for watching positions move against you before they move in your favor. Then, if you decide exposure makes sense, consider building it gradually, not all at once hoping to catch the exact bottom. not in a panic if the price starts running, but methodically, perhaps over weeks or months, allowing yourself to dollar cost average into a position while you continue learning. This isn't about missing out. It's about participating intelligently if you choose to participate at all. The investors who regret their decisions most aren't usually those who missed a move entirely. They're those who jumped in emotionally, bought at the peak, panicked when it corrected, and sold at a loss. Don't be that investor. Remember that not every opportunity is your opportunity. If this setup doesn't fit your knowledge level, risk tolerance, or portfolio strategy, there's no shame in sitting it out. The market will create other opportunities. It always does. Your job is to participate when the fit is right, not to catch every move in every asset. Let's talk about what not to do, because this is where most people sabotage themselves. Don't invest money you need for living expenses or short-term goals. Silver is volatile. It can move against you for months before moving in your favor. If you invest money you can't afford to tie up, you'll be forced to sell at the worst possible time, probably right before the move you were waiting for finally materializes. This is how most retail investors lose money in volatile assets. Don't use leverage unless you're an experienced trader with a proven track record and a rigorous risk management system. The temptation to amplify returns through options, margin, or leverage products is strong when you believe a move is coming. But leverage turns volatility into devastation. It forces you out of positions right when maximum pain hits, which is often right before the turnaround. The people who profit most from major moves in silver are usually those holding physical or unleveraged positions. Don't chase headlines or social media hype. If your decision to invest comes from a viral post or breathless YouTube video promising specific price targets, you're already making an emotional decision, not a strategic one. The best time to build positions is when no one's talking about an asset, when it's boring and frustrating. By the time everyone's excited, much of the easy money has often been made. Don't ignore the rest of your portfolio. Even if you're right about silver, it shouldn't become 50% or 70% of your holdings unless you're a professional trader with extraordinary risk tolerance. Concentration can build wealth, but only if you're right and you time it well. For most investors, diversification and balance remain important even when you have a strong conviction about one particular asset. Don't forget to think about exit strategy before you enter. This sounds obvious, but most people don't do it. They buy an asset thinking about how much they hope it will go up, but without any plan for how they'll know when it's time to take profits or cut losses. Have some idea, even a rough one, of what would make you sell. Is it a specific price level? A change in the macroeconomic backdrop? A technical pattern? Know your exit criteria before you commit capital. Don't expect the move to be smooth or comfortable. If silver does have a major move this year, it will likely include sharp corrections that feel like the move is over. It will include news articles explaining why silver is overvalued. It will include periods where you question your decision. This is normal. This is how markets separate patient investors from weak hands. If you're not prepared for discomfort, you're not prepared for the position. And finally, don't invest in what you don't understand. If you've watched this video and still don't grasp why someone would own silver, if the macroeconomic arguments don't resonate with you, if the whole concept feels too speculative or confusing, then don't invest just because someone else thinks it's a good idea. Invest in what makes sense to you, what you can explain clearly, what fits your broader financial strategy. We've covered a lot of ground. Let's bring it back to what matters. Silver is positioned in a way it hasn't been in years. The macroeconomic backdrop, the technical setup, and the market structure all suggest that something significant could happen in the coming weeks and months. March may prove to be an inflection point, or it may simply be another step in a longer process. No one knows with certainty. What we do know is that being prepared, being educated, and being disciplined will serve you better than trying to predict exact timing or chasing exact prices. The investors who navigate uncertainty best aren't the ones with perfect information. They're the ones with clear thinking, appropriate risk management, and the emotional control to stick with their strategy when markets get volatile. If you hold silver, stay patient. Your thesis may be about to be tested in the best possible way. If you don't hold silver, take time to consider whether some exposure makes sense given the world we're living in. And whether you invest or not, stay informed, keep learning, and remember that the best investment decisions are usually boring, methodical, and made without urgency. The crisis isn't coming. The crisis is already here. It's in the debt levels that can't be sustained. It's in the monetary policies that have run out of room. It's in the confidence that's slowly eroding in paper promises backed by nothing. Silver doesn't create that crisis. Silver simply responds to it. Your job is to understand what's happening, position yourself accordingly if you choose to, and maintain the discipline to see it through. That's how you protect wealth in unstable times. That's how you potentially build wealth when others are panicking. And that's how you ensure that when the dust settles, you're still standing. Thank you for watching. Stay sharp, stay disciplined, and remember that in finance, preparation and patience matter more than prediction.